Hey everyone. 3 weeks ago, Australia's opposition announced they're scrapping net zero. This policy backflip will reshape Australia's property market in 2026 and beyond. Today, we're breaking down exactly what changed, what it means for property values, and how smart investors should adjust their strategies right now. So most investors have no idea how policy changes affect property markets, but we'll reveal the specific mechanisms that will impact rental costs, construction timelines, insurance premiums, and capital growth over the next decade. Stick around because by the end, you'll understand how to position your portfolio around this shift. All right, so welcome back to the channel where we turn policy shifts into investment intelligence. Today's episode is critical for property investors because what happened in federal parliament 3 weeks ago will ripple through the housing market for years to come. So here's what happened. On November 13th, 2025, the Liberal Party announced they're scrapping net zero from the Climate Change Act if they're elected. They're ditching both the 43% emissions reduction target by 2030 and the broader 2050 net zero pathway altogether. Now you might be thinking, well, that's just politics. How does it affect my property investment? So the answer, quite significantly, because building codes, construction costs, insurance premiums, rental market dynamics, and property valuations are all tied to climate policy and emission standards. Today, we're walking through exactly what changed, what this means for the housing market, and how you should adjust your strategy heading into 2026. So let's establish what just happened. The Australian Labor government, currently in power, committed to a 62 to 70% emissions reduction by 2035. That's a significant tightening on climate targets. This government invested billions into renewable energy transitions, building standards upgrades, and emissions reduction pathways. However, the Liberal Party, the main opposition, likely to govern from 2027 onwards, just announced they're reversing this direction entirely. They're scrapping the legally binding net zero 2050 target, the 43% 2030 reduction target, and the federal funding and policy apparatus for emissions reduction. If they're elected, Australia will remain in the Paris Agreement, but abandon legislated emissions targets. They'll move to a flexible year-on-year reduction approach aligned with comparable countries, prioritizing energy affordability over climate targets. So why does this matter for property? Because Australia's building and construction sector was fundamentally restructured around net zero targets. New regulations, building codes, material standards, and financial requirements were all being built around decarbonisation pathways. When those targets evaporate, the regulatory frameworks change. And when regulatory frameworks change, property markets move. So the National Construction Code, which is Australia's baseline building standard, has been progressively tightening emissions requirements. The NCC 2025, due in May 2026, was supposed to introduce mandatory solar readiness on all buildings, enhanced water efficiency standards, car park energy efficiency measures, and first steps toward embodied carbon requirements. The NCC 2025 is locked in. That's already through government approvals. But here's the critical bit. The building ministers agreed to pause further residential emissions changes until 2029, except for essential safety measures. So what does this mean? For 3 years, 2026 through 2028, no additional embodied carbon mandates, no additional operational efficiency requirements, no forced retrofitting standards. Construction can proceed with looser emissions requirements than what was forecast 12 months ago. So why is this a big deal? Right? Lower construction costs. If builders don't have to meet emerging embodied carbon standards or advanced efficiency requirements, build costs come down. Lower building costs equal lower final purchase prices, which equal more affordable properties entering the market. So here's an example for you. A new 4-bedroom house in a Melbourne growth corridor was forecast to cost an additional $12,000 due to embodied carbon reduction requirements and enhanced efficiency standards. If these standards are deferred, that house might cost $12,000 less. Over a development of 200 homes, that's $2.4 million in eliminated costs. Those savings flow through to purchase prices. However, and this is the crucial however, costs might initially stay high because builders don't instantly adjust pricing downward. Builders will pocket the margin savings initially. It'll take 2 to 3 years of competitive pressure for savings to flow through to buyers. So the second impact, slower renovation incentives. No strengthened retrofitting requirements for existing homes means less pressure on landlords and owner-occupiers to upgrade. The government's Household Energy Upgrades Fund, which was providing low-interest loans for home improvements, will be deprioritised under a future coalition government. What's the property market effect on this? Rental properties will remain older, less efficient, but cheaper to acquire and to operate. This favours yield-focused investors over those chasing premium lifestyle properties. Australia's construction sector was bracing for a shift towards low-carbon materials. Manufacturers were investing in low-carbon cement, recycled steel, sustainable timber, and alternative aggregates. These materials cost more upfront. Current embodied carbon from buildings, 21 million tonnes of CO2 equivalent annually. The building sector was targeting a 23% reduction in upfront embodied carbon by 2026 through material substitution. With net zero scrapped and building code changes paused until 2029, demand for those premium materials evaporates. Manufacturers won't accelerate investment in low carbon alternatives. Supply chains won't shift, and traditional materials, so cement, virgin steel, conventional timber, remain dominant and cheaper. What's the property market effect? Well, construction timelines accelerate, they shorten, without forcing builders to source rare low carbon materials or navigate complex embodied carbon calculations. Builds proceed faster using conventional supply chains. Faster construction means more new supply, which means more downward pressure price on growth suburbs. Specifically, building timelines expected to lengthen by 6 to 12 months due to low carbon material sourcing won't materialize. Developments currently forecast to complete in Q4 2027 might finish in Q2 2027 instead. Supply timing matters enormously for property markets. When supply hits markets faster than expected, rental markets soften first, vacancy rates rises, and rents stagnate. Then buyer confidence dampens because they see rising stock and weakening rents. Suburbs like Ripley, Chambers Flats, Fraser Rise, and Donnybrook, all high-growth precincts with thousands of dwellings in the pipeline, will see accelerated completions. This is bearish for short-term capital growth, but bullish for affordability and yield. So here's where net zero scrapping gets genuinely concerning for property markets. Abandoning climate targets means accepting higher global temperatures. The Climate Council estimates that abandoning net zero will result in 4 times the number of severe and extreme heatwave days. 1.5 million Australians exposed to coastal flooding by 2050, double the amount of extreme fire days, and vast regions becoming uninsurable. This isn't hypothetical, it's already happening. In 2025 alone, 3 major events, North Queensland floods, ex-tropical cyclone Alfred, and the Hunter region floods, generated $1.8 billion in insurance claims. Flood risk alone is already putting a $42.2 billion dent in property values across Australia. Queensland loses $19 billion due to flood risk. New South Wales loses $14 billion. What does net zero scrapping mean for this? If we're accepting higher climate impacts, insurance companies are already factoring this in. They're withdrawing from high-risk zones entirely. For example, Suncorp withdrew from Roma, Queensland after the 2012 floods, dramatically increasing premiums in flood-prone areas, or refusing coverage for climate-related risks, such as actions of the sea, erosion, subsidence, certain flood types. 1 in 5 people in Northern Australia don't have home insurance. If you can't get insurance, you can't get a mortgage. If you can't get a mortgage, guess what? You can't sell. If you can't sell, your property becomes illiquid. So the property market effect here, suburbs with moderate flood risk will see valuations crater. Homes in 25-year flood zones will lose equity. Insurance costs will spike, making rental less profitable. This specifically impacts Brisbane suburbs, Gold Coast and Moreton Bay regions, river suburbs, right? New South Wales, Lisbon regions, Hunter Valley, the coastal regions, and then even in Melbourne, lower-lying suburbs near rivers and coasts, for example. These aren't mainstream investment precincts, but they're important because they show how climate policy absence creates valuation risk. But then here's the counterpoints, right? Premium locations like hill suburbs, elevated areas, bushfire protected zones will see relative uplift in value because they're becoming scarce and safe alternatives. Net zero was driving a transition to renewable energy, electrified heating and cooling, and solar installations. This was making rental properties more expensive to operate, but cheaper for tenants to live in. Government incentives were subsidizing solar batteries. The small-scale renewable energy scheme offered rebates worth thousands per installation. Landlords were installing solar and batteries to boost rental appeal and tenant retention. And with net zero scrapped, these incentive schemes will likely be wound down or potentially even eliminated. Solar rebates, currently worth $340 per kilowatt hour for batteries, are forecast to drop 10% annually anyway. With policy scrapped, they might be eliminated entirely by 2027. So what's the property market effect? Two scenarios. Scenario one, landlords don't install solar or batteries without subsidies. Rental properties stay on grid power and electricity costs rise for tenants without competing for renewable incentives. Tenants absorb higher power bills, rent growth moderates because tenants push back on power costs, and yields stagnate. Scenario two, government adds tax incentives instead of rebates. Landlords get accelerated depreciation or tax write-offs for solar/battery installations. Solar adoption continues, but at a slower pace. Rental properties gradually become more efficient, but market-driven rather than mandate-driven. So what's most likely? We reckon scenario one plays out. Without active government support, solar installation rates on rental properties will decline. Rents don't surge because power efficiency stalls, and yields stay flat. For yield-focused investors, this is neutral. For growth investors betting on rental upside from efficiency, it's negative. Net zero policy was creating different growth trajectories for different regions. Renewable energy regions, such as Queensland Solar, South Australian Wind, were poised to see employment growth and infrastructure investment. Net zero scrapping means less urgency on renewable expansion. Regional towns like Townsville, Rockhampton, and Toowoomba lose policy-driven employment tailwinds. Climate-vulnerable regions, such as coastal Queensland or northern New South Wales, were seeing property values deflate due to climate risk. With net zero scrapped, climate impacts accelerate. Property values in these regions will continue deflating. Energy-intensive rural regions, so coal mining areas, agricultural heartland, see policy uncertainty lift. Coal mining adjacent regions like Rockhampton, Hunter Valley had uncertain futures under net zero. With it scrapped now, these regions have more stable policy outlook, which can support property values. So specific regional impacts, Townsville, Mackay, Cairns, potential moderate slowdown in renewable employment growth, but still population driven. Property growth moderates, but doesn't reverse. Gold Coast Sunshine, the real risk here is climate risk. Right? That climate risk will still remain. Property values in flood-prone areas continue to depreciate. Elevated areas will continue to appreciate. Bifurcation deepens. Newcastle, Hunter Valley, policy uncertainty lifts, so coal communities have more stable futures. Property values stabilise after years of decline. And Adelaide and Perth, wind and solar investments will continue regardless of net zero because they're commercially viable and will have minimal impact. So here's how to adjust your investing strategy for a world where net zero is no longer driving policy. 1. Prioritize cash flow over speculative growth. Without emissions mandates pushing rents higher through efficiency gains, rental yields matter more. Target properties with 4% plus growth yields in sustainable submarkets. 2. Avoid extreme climate risk areas, so coastal flood zones and high bushfire risk suburbs face ongoing valuation pressure as insurance costs spike and insurability becomes uncertain. Neutral risk suburbs offer better risk adjacent returns. 3. Focus on new construction precincts. Building code changes paused until 2029 means construction timelines short and costs stabilize. New supply hitting the markets faster creates temporary buy opportunities before the prices stagnate. And 4, reconsider solar and battery investments. Without subsidies, solar ROI return on investment on rental properties extends significantly. Focus on properties where solar makes financial sense, independent of policy, high sunlight regions, and high power cost areas. And 5, watch regional energy policy very closely. If new governments bring their own energy investment priorities, regional markets could pivot. Monitor quarterly for emerging policy signals. Look, if this policy analysis was valuable, hit the like button and subscribe. Drop a comment below. And how do you think the net zero backflip will impact your property strategy? I read every comment and feature the most insightful ones. So this is how we stay ahead, by understanding policy before it moves markets. And if you're ready to build a property strategy resilient to policy shifts, join our exclusive members group where we track policy developments quarterly, update some evaluations, and based on regulatory changes. We also provide strategic guidance on navigating uncertain policy environments. We'll help you identify which suburbs are benefiting from the new policy framework and which are facing headwinds. So book your call in today. Thank you for watching.